Hello, good afternoon, guys. Okay, so uh, following up on my video that I've done earlier, hopefully you've seen it uploaded onto YouTube, privatized for you guys, of course. So just trying this out, see if I get some slightly better delivery, I suppose. We all get a shed load of emails and appreciate I love an email. But also people don't have time to just sit and read emails all day. And sometimes the way that I explain things doesn't come through clearly. So what I want to do is try something new, start adapting this in a way that I can share information on an audio and visual level. Hopefully that might increase understanding for you guys, the clients. Hopefully that is something that you'll find beneficial, and it's something that we can continue. If you don't like this, please let me know. Feedback's always welcome. But to give you a prime example of one of the things that I talk about quite a lot that gets interest, but then I also get a lot of questions about people aren't quite sure how it works. So you'll have heard me speak about the VIA structured note program on a few different occasions, I'm sure. And it's really hard to explain either over the phone or just over on Zoom. So in this manner, I'm allowed to draw it out. You can rewind, go back, rewatch, try and get some explanation. This is really important right now because it's mostly done through fintech. Okay, so for in the last year, so in 2022, fintech grew by 65% usage from clients and the public in general. So I think it's really important that people get a grasp on how they invest. So structured notes, they might sound complicated. They're not really that complicated. And what I want to do is highlight the benefits of them, particularly over a short to medium term. So what I'm going to do is I'm going to share my screen, and hopefully this is going to work. Let's give it a go. Here we go. All right. So this is one of the structured notes that we've got available right now. Okay. Really popular. I've had some clients already invest in it already. But this is brought to us by, this brought to us by BBVA. Okay. It's prime markets. It's a semi-annual return. It has an auto call feature and it's got a memory feature. Okay. And I'll run through that shortly. It's based on the S&P 500, the Nikkei 225, and the Euro Stoxx 50. Okay, so to put that in simple terms, the US, Japan, and European markets. All right, three major markets across the globe. This starts on the 31st of January this year, and the coupon is 6.375% every semester, which is 12.75% per annum. Now, 12.75% per annum, as you can tell, very good return. And particularly interest rates are going up, okay, but inflation's quite high. So we're trying to look into always beat inflation. And likewise, in my opinion, interest rates are going to fall again. So it's important for you guys to look for opportunities, or for me to introduce you to opportunities that are going to help preserve and grow your capital. All right. So the way that this works is on the 31st of January, BBVA, all right, they're going to look at these three markets and they're going to mark them at 100%. Okay, so it's going to start here. Now, the way that these work, it's always done on the worst performing index or stock or indices. You might have seen some of these out that I've sent. Okay, and so on the 31st of January, let's assume, all right, that the S&P is the worst performing stock and it has a terrible time. There's a lot of talk about recessions right now. Not that that really affects the market, but the S&P from the 31st of January has a terrible time, okay, and it drops or bounces around in value, and every 6 months there's an observation date. Now, when it has this observation date, not above 100%. Okay, so in which case it keeps continuing. So as we go through, it's not having a good time, and we get to year 4.5, and it comes back above the 100%. Remember, it's been the worst performing one all the way through this. Now, at that point, after 4.5 years, it comes back above the 100%. Now, this auto call feature that I mentioned earlier, that means that it comes to an end early. So you see here, 4.5 years, it's got a 6-year term, but it's come to an end early after 4.5 years. At this point, you're going to get your full capital back. Apologies. Now, you'll notice that along here, okay, you've actually accumulated 9 coupons that have not paid. And this is where that memory feature kicks in. So at this point, it comes back above the 100% line on an observation date. You get your full capital back, but then you've got 9 coupons where you've not had a return in 4.5 years. So based on a $50,000 investment, you're going to receive 9 coupons of 6.375%. Okay, so 9 coupons. Now, in terms of return on investment, that is actually 57.375% return. Now, if I put that into a monetary value based on 50,000 US dollars, that's 28,687.50 US dollars that you're going to receive back at the 4.5 years in this example. So as you can see, all right, you've not had anything for 4.5 years, but actually when it comes back up, you've generated quite a nice return. It does over 10% per year. Now, you might be thinking, okay, well, that sounds very good. All right, so this auto call feature kicks in when? All right, so actually, the auto call feature kicks in after the first semester. In which case, if the markets do well, and again, let's assume the S&P 500 is the last one, and the markets do well, and we get to 6 months, and they're up here, well, guess what? Get your full capital back. And 1 coupon of 6.375. And that can happen at any point on these observation dates. As long as all 3 stocks are on or above 100%, it will auto call, come to an end, pay you back your full capital, and then however many coupons of 6.375 have accumulated over the term. Now, I appreciate that sounds very, very good. And it is very, very good. That was so cheesy, forgive me. But there is always a risk, okay? And I wouldn't be doing my job right if I didn't address the risk that's involved with these types of products. So the first thing is, you'll notice here along the side, capital repayment threshold. And you'll also notice that I've got 65% marked here, which represents a 35% drop. Now, if we get to the end of the 6-year term, this is the only time that this ever comes into play during the lifetime of this product. So anytime it comes back above 100% in this category, okay, get your full capital back and any coupons accumulated. If, for instance, it falls and comes to an end in this category, so for that to happen, none of the indices have to have fallen by 35% from when they start on the 31st of January. You might not, and it finishes at this point at the end of 6 years. Okay, well, you get your full capital back. Okay, capital protection is built into this. Risk, of course, is you go 6 years without getting a return, during which point inflation might have been jumping around and the value of your money is eroded. Okay. Worst case scenario is it goes to 6-year term, you've not had any coupons, and it finishes in this section here, below the 65% protection barrier. What happens at that point is capital is at risk on a one-to-one basis. For example, worst performing index has dropped 40%. Okay, well, 40% of your capital is at risk, which sounds like a lot. And again, I appreciate that. But the one thing that I want to highlight to you, and I want you to consider as an investor, is first of all, considering the last 12 months that we've had, which have been extremely choppy. So the S&P is down over the last 12 months, 9.92%. Nikkei 225 is down 2.47%, and the Euro Stoxx 50 is actually up 1.85%. The question that you need to ask yourself, and it's a question that I'll highlight, is from this 31st of January, in the 6-year point or 6-year term, do you think these markets are going to fall by 35%? Well, the answer is they could, but it's unlikely after the really volatile year that we've had. Okay, you've got to ask yourself in 6 years' time, do you think they're going to drop more than 40%, for example, if your capital's at risk? Well, in my opinion, I think in 6 months, we're probably looking at the market being up here somewhere. In which case, this comes to an end after 6 months and pays you 6.375%. So it's all about perspective when it comes in investing. And I appreciate we've had a really choppy 12 months and a lot of people are looking at negative valuations. But this is a way of accumulating returns over a longer period or medium-term period in the hope for longer-term capital gain. So in the first example I gave you, 57.375% return in 4.5 years. That's more than anybody's getting on property. So that's how I feel about it. So again, just quickly going to share this with you, see what it's like. Appreciate this video has probably gone on for quite a bit of time. Check afterwards. If you want to have a look at some opportunities like this that we've got and then ask me questions on them, what I really recommend, okay, is you can go to the Google Play Store, go to the Apple Store, type in Devere Investment app. Okay, this is the logo that you're looking for. And I would recommend registering. So to register, you need passport, Visa or Emirates ID if you're in the UAE, and you need a proof of address. So if you're in the UAE, a DEWA bill, and once you're on there, you'll be able to register. My referral code is 27604 when it asks for an advisor code. And you'll be able to see a list of everything that we've got available. All right. Speak to me, ask me questions, give me feedback on this. And yeah, let's go from there and see how this has worked out, because I don't know. Thank you very much for your time and have a nice evening. Thank you.